Hey, bulls and bears, my name is JJ. You're watching Bull Boom Bear Bust, back with another dose of economic reality as usual. Today, again, we will get into the latest economic numbers, including the jobs report, deflation. We're actually seeing prices declining year over year in a few different items, a few different categories. We'll talk about that. Also, we have some very interesting numbers to go over here, and we're going to paint the picture on the direction of the economy. If you like these updates, please give us a like, help get this video a little bit of traction, help keep us alive here on this platform. Let's go ahead and start right here. The jobs report. Now, we did touch on this in our last video. Jobs came in higher than expected, 216,000. There's a lot behind this, though, that we need to talk about. This was market positive. It was looked at as a great thing, good news. The economy's growing, the economy's strong. Of course, it's 2024. They want the economy to look as good as possible for obvious reasons. Now, 216,000 jobs added. Better than expected. They only expected 170,000. But let's talk about the numbers, because when we look back at the previous 11 jobs added numbers, the monthly numbers, 10 out of 11 of those were revised downward, and all but I think 2 were revised downward to below what the expectation was. So they report this news, and it's a good thing. It's market positive. It's put out there on all the business news channels, and they're touting how great the economy is. Look at all these jobs, and then they revise it a month later. But by the time the month gets here, the following month, they're reporting the new numbers. Everybody's looking at the new numbers, and they're not thinking about the last month's numbers that were revised downward. But the last 11 out of 10 times, 10 out of 11 times. So this can't be a mistake. It can't be, well, they just got the numbers wrong. This is done on purpose to give you a false sense of how the economy is actually doing. All right, so pretty interesting. But also on top of that, you have a lot of other information that really paints the picture that things aren't really looking so good with these jobs numbers, right? We have 1 million new unemployment in a month. We had only 216,000 jobs added. Many of those jobs, about 25%, were government jobs. And another thing about these, a lot of these jobs were second and third jobs for people that just can't afford the cost of living right now. And all you have to do is look at the levels of debt right now. Why are people going deeper and deeper and deeper into debt? If these jobs were so good, if they were paying so much, why are people going deeper into debt each month? Now, that's the next thing that we want to talk about, because obviously everyone wants to know if and when we're going to see another crash, a downturn, a recession slash depression. People want to know so they'll be able to make money and prepare for it. Obviously, if you know exactly when the market is going to correct, or let's say you knew when the housing market was going to crash, you would benefit greatly from that if you were able to hold off on buying a home and then waiting to buy one on the other side when homes are half price. So, of course, everybody, well, not everybody, I should say about 35% of the people want the housing market to crash, and that's about equal to the number of renters. The home ownership rate in the United States is just over 60%. So the other 40%, the renters, is pretty close to that number. There's a new survey out of the Salem News. 35% of Americans want a housing crash. But the reason I wanted to bring up a housing crash is because a lot of people have been waiting for it, and they've been waiting for a long, long time, ever since home prices went beyond what they were back in 2007, 2008, before the last housing bubble went bust. And we've called this here a housing bubble, meaning it's overinflated. But just because something is overinflated doesn't mean it's going to correct. And it's hard to put a timeline on that, because if it's overinflated, how do you know that they're not going to do more of the same things, more of the same stimulus, and more of the same types of policies that inflated the bubble in the first place, right? So higher interest rates, that's just a part of the picture. You have to look at how money's issued. And when you look at credit that's available, credit is actually expanding. And if you look back at the previous quarter, it expanded. Now, we just looked at something at the end of December that said it was starting to decrease from the previous month. But over the last quarter, credit expanded. As long as people can borrow more and more money, then you're very unlikely to see any sort of market crash, a housing crash. The car market will not crash. It's coming down, though. Car prices have come down some. But as far as a crash, I've always said here, I do not predict a crash because I think the powers that be, the central planners, learned their lesson back in 2007, 2008, right at the very beginning of the bank crisis, the banking crisis. Banks, for more or less, shut off lending completely. It was very difficult for several months to get any loan at all. There was a lot of panic, there was a lot of uncertainty, and a lot of unemployment came out of that. So this time they're being very, very careful. We see that they're still pumping a lot of money into the system here, into the economy to keep things operational. And in fact, we're pumping so much money into the economy, the U.S. deficit just topped $500 billion in the first quarter of the fiscal year. October, November, December, $500 billion in just that 3 month time span. So we know they're still throwing a lot of money at this problem, a lot of fuel onto the fire. And we wonder why inflation ticked back up again last month. All you have to do is look at what's happening here with the amount of spending that's going on here, how much the deficits are rising, the debt is rising faster and faster every time you look at it. It's increasing, it's accelerating. So from October 2023 through December 2023, the budget deficit totaled just shy of $510 billion, following a shortfall of $129 billion in December alone. So as we went into the later months in the year, it continued to increase and get worse and worse and worse. So this is why I've always said here, I'm expecting more inflation than I am deflation. Now, where are we seeing deflation and falling prices? Well, there's a few things here. And, people say I don't have good news. By the way, I'm going to react to my latest celebrity look-alike accusation. People tell me sometimes I look like famous people. Some of them, I can kind of see. Some of them, no way. This latest one, I can kind of see a little bit. We'll talk about that towards the end of the video. Maybe have a little fun, right? Here's the prices that came down, though. As of December 2023, year over year, so comparing December 22 to December 2023, eggs down almost 24%, lettuce down 17%, tomatoes down 7%, apples down 6%, breakfast sausage down 3.7%, cheese down 3.3%, butter down 2.9%, potatoes and fish both down about 3%, milk down 2.3%, roasted coffee down 2%. Also, it goes into energy here. Fuel down almost 15% year over year. Still higher than 2020, though. All these numbers actually still higher than 2020. So this is just year over year. Propane and kerosene down 5%. Let's see here. Depending on your area, gas down between 5 and 13%. Health insurance, wow, down 27%. Laundry equipment down 13%. Car and truck rental down 12%. Televisions 10%. Toys down 4.5%. So people saying that there's nothing good happening. Well, I guess if you want to look at more affordable items than those items that I just listed off, and it goes on. Men's suits down 6%. Moving and storage, freight expenses down 3.4%. But these are down over a very, very elevated number, is what I want you to focus on. If things continue to trend in this direction, maybe we'll see the cost of living start coming back down. But if you look at most households are having a very, very difficult time. And the studies are out there that it's between 60 and 70% of people live paycheck to paycheck. And when you look at the ownership in the stock market now, it's 92% of all stocks are owned by the top 10%. The top 10%. Right? So that's just kind of paints a picture on where most people are at. Most people, paycheck to paycheck, savings dwindling, going further into debt each month. And if you're one of the few people that's saving money and paying off debt each month, like gaining more in savings and getting rid of debt, then you're in the very small fraction of the population. I'd say about maybe the top 20%. Lucky if you're in that top 20%, or maybe skilled, depending on how you want to look at it. Oh, and I forgot to mention, back on the jobs number, a lot of those jobs, a big portion of those jobs that were added, that were probably way over exaggerated, were part-time jobs. So you have second jobs, third jobs, and people don't want to work multiple jobs, right? People want to work less. I was listening to a podcast, and I can't remember if it was Shift, and they basically said nobody says thank God it's Monday. You hear thank God it's Friday because people are looking forward to time off. They're looking forward to the weekend. You rarely hear, maybe never, thank God it's Monday. So people don't want to work these extra jobs. The reason they're working these extra jobs is because they have to, just to put food on the table, just to pay the housing costs, just to pay all the necessities, the utilities, the insurance, etc. So this is what's happening, and people are more stressed out. I saw a survey that said the use of antidepressants and things like that are increasing. So it kind of goes along with what's happening with the economy, right? So let's talk about this. Citigroup expecting to cut 20,000 jobs by 2026 after a very disappointing quarter. So more layoffs. And what they will do is they will add up all the jobs that were taken by these people here, by the 20,000, as we go into the years and into the layoffs. And they'll say, look at these jobs added. And a lot of the jobs added too are people that got laid off and just went out and got a different job. And it could be a job that pays much less than the original job, but they're still going to report it as positive jobs added. Most people just look at the number and they say, wow, the economy's not doing bad. Everything's fine, having no idea what's really behind it. The Fed posts the largest annual operating loss. Even the Fed is losing money. How bad do things have to be when the Fed is losing money? The central bank's deficit of $114 billion last year resulted from its efforts to stimulate the economy and then stamp out inflation. Now, you often hear the Fed's printing money, they're creating money, the money print to go burr, when actually money is created out of the Treasury. Now, the Fed, they can buy bonds and treasuries with fictitious digital money, but when it comes to the actual printing press, that's located elsewhere. So the question would be, why don't they just create money to pay off this $114 billion? You might want to ask yourself that question. Let's talk about car prices. Used car prices are down. We're down 7% at the end of 2023. We'll have to see what happens here at the end of January. Car prices are down 7%, but there's a forecast that prices will go up this year in 2024. And I just had to find the article here. Also, according to Manheim Used Vehicle Index, used vehicles are down now 21% from the all-time high. So down 7% in just 2023, down 21% from the all-time high. So for those of you that waited, you're rewarded pretty nicely if you were able to drive your car longer than you would have if you would have went out and bought a new vehicle. So if you kept your old vehicle on the road and now you're buying versus last year or the year before, you're saving yourself a good amount of money. Even if you have a lot of money, it's no fun to overpay for something, right? I remember buying something for just a few dollars at the mall, going to another store, finding it for a few dollars less. Didn't break my wallet, but I was still feel bad just about wasting a small amount of money. And this, when you look at the cost of cars, it's not a small amount. 20 something percent on a car. If you go out and buy a $20,000, $30,000 car, you're talking about, a little bit of change. In that case, there was a report though I wanted to bring up here. Let me continue to search for it here. Oh, but also Bloomberg, according to Bloomberg, buying a used car is still more expensive, even though the prices are down because of the higher interest rates, right? Prices really should correct more than just the difference between the lower and the higher interest rates, because usually when there's a bear market, people refrain from buying, but we have the banks out there still loaning out a lot of money. Credit is expanding for the most part, and therefore people are still able to go deeper and deeper and deeper into debt. More credit card limits are increasing versus decreasing. So that's another reason why we're still seeing, very sticky inflation. In fact, prices are still going higher. Also, when you factor everything in together, we talked about a few items that the prices dropped, but altogether, things are really going up. Look at insurance. Insurance is a big one this year. Home insurance, car insurance, the cost of repairing these vehicles. It's really eating a lot of household budgets right up. Well, let's talk about the Bitcoin ETF. I know not many of you people are invested in cryptos, or maybe a lot of you, but as far as a percentage of my audience, not, I don't think it's a majority. I think it's a minority, less than 50%. But the Bitcoin ETF, people were asking me about that. What I see is that opening up the door for a lot more manipulation in the price of Bitcoin. Because when you just look at Bitcoin, it has a limited supply, and about 70% of all the Bitcoins are being held by people and not traded. So you only have the extra 30% out there, the other 30% that's able to be traded. So it's a very low float. And that's one of the reasons why the price has gone up so high, is because there's a limited supply. So the ETF, in my opinion, I'm not going to invest in it, but in my opinion, it's going to create a lot more volatility, because now what could happen is big investors can go in and short the ETF and buy up the ETF as well. And if it's tracking Bitcoin, you could see a lot more volatility in Bitcoin. Um, I don't think it's a good item. I really don't get into ETFs for the long run. I trade them for the short run. For example, right now I'm shorting a retail ETF, and it's doing pretty well. For those of you that got into this at the end of November when I brought it up, you're doing pretty well. You're up about 18%. I was hoping for more, but anytime you're up instead of down in this market, you're doing pretty good. But retail, and the retail ETF is the only place I'm short in, is because there's still so much money being pushed into this economy that I really don't see a stock market correction, or a big one, maybe a minor one, but nothing big, or nothing that I would want to short the entire indice or any of the major indices. Anyways, let's go ahead and talk about this. The credit card delinquency rate, folks, it finally happened. The delinquency rate climbs to a decade high, according to a recent study. Prior to this, the big area of a delinquency that was noticeable was car loans. Car loans were late at a 30-year high, 3-decade high. Now credit card delinquencies continue to rise to a 10-year high now. And even with that, credit card companies are still increasing these credit lines. Right? So something's going on where the banks and the credit card companies are really confident that maybe they're going to have endless life support or endless liquidity. They're not afraid of people missing their credit card payments. All right. There's so much money being pushed out into the economy right now that this is an inflationary bubble more than it is a deflationary. And when you have those two forces that are equal, you have stagflation. And if you look back at history, stagflation is typically not a very fun time. But you can still have fun. Hey, let's talk about this actor that my latest, I've been accused of looking like, let me just try to name a few of them. Woody Harrelson. I didn't really see that one at all. The other one that was kind of common for a while was Fred Durst. Fred Durst, I don't think I look like him. The lead vocalist for Limp Bizkit. The latest, somebody put this in comments. You look like the actor from Yellowstone. And the actor Jefferson, his last name is White. Let me go ahead and bring it up here. Apparently, this is my twin. Here he is, right here. Does this look like me, folks? I think he looks, wow, he looks really skinny. That, I guess, looks a little bit like me. Maybe the eyes. Let me bring it up side by side here. What do you think? Maybe the eyes, maybe the nose. Oh, I guess that's pretty close. I don't know. Wow. All right. So Jeffrey White from the show Yellowstone. I've never watched it, actually. I don't watch a lot of TV, just because time. But I cut the cable and just using streaming sticks right now. It is a nice savings from the old cable bill there. So just one thing I'm doing to cut back. I could pay for cable, but I just don't like I said earlier, I don't like wasting money. I don't watch a lot of TV. I do watch sports. I like sports, especially MMA, football. I just try not to throw a lot of money at sports, and I don't like to go to a lot of games. If somebody gave me free tickets, I would probably go to a game. Uh, Concerts, I like to go to concerts. I don't like to spend a lot of money. I don't go to see big bands or big acts. Once they get huge, like I'm not going to go see a Beyonce or some huge act like Coldplay, because the ticket prices are just insane. Um, I like budgets. I like what's the word for it? I like deals. So even if I'm going to see a concert or going to watch sporting events, I like deals. Anyways, that's my report for today. Hope everybody likes this. What do you think about my celebrity lookalike? What do you think about the jobs numbers? All the backward revisions that were done, 10 out of the last 11. The whole jobs number is a scam here. So how good is the economy really doing? Please let me know. What do you think about 20,000 layoffs out of Citigroup? And that's all the way up until 2026. That's a long time. So you may not think it's that much because it's over a extended period. But the bigger question is, what does Citigroup see going on in the next few months, or the next few years rather? What do they see that most people might not see, and why are they announcing these layoffs so early? So looks like something big maybe about to pop off. I can't give you a time frame. All I can say is be ready for anything. Be ready for a plunge. Be ready for more painful inflation, cost of living, because we don't know what these manipulators are going to do there. But we just have to be ready for everything. Thanks everybody for watching. Keep stacking now. Bye for now. Peace.